on the mortgage market. We appreciate you joining. Again, this is Matt Patton. It's 11:05, and we are ready to get started. I'd like to introduce you to our panelists today. Andy Frey is a CFA and a Vice President here at Cutler, and joining him is Jeff McGinnis, a mortgage consultant with Wallick Volk. Good morning, gentlemen.
Good morning, Matt. Thank you. Thanks to everyone that dialed in to join us today. As Matt said, I'm Andy Frey, a Vice President with Cutler. Today I'm joined by a good friend and trusted resource, Jeff McGinnis, a mortgage consultant with Wallick Volk here in the Seattle area. The interest rate environment certainly has changed over the first half of 2018, including mortgage rates and their impact on housing affordability. We've received a lot of questions or inquiries from clients about home purchases, refinances, or paying off loans. So I wanted to partner with an expert that I know in this area to discuss. So Jeff, thank you for joining me today.
Thanks, Andy. I appreciate it. Appreciate being here, and good morning.
Before we begin, just a quick disclaimer to get out of the way. The information, analysis, and opinions expressed herein are for general and educational purposes only. Nothing contained in this presentation is intended to constitute legal, regulatory, tax, accounting, securities, or investment advice, nor an opinion regarding the appropriateness of any investment, nor a solicitation of any type. Information obtained from third-party resources is believed to be reliable, but not guaranteed. All opinions and views constitute our judgments as of the date of writing and are subject to change at any time without notice. Now that we have that out of the way, I just want to give a quick primer on where we are today in sort of the interest rate cycle and what's going on out there. What you're looking at here on page 3 is called the FOMC dot plot. That's the Federal Open Market Committee, the Federal Reserve, and it's part of their summary of economic projections. Essentially, what you're looking at are these little dots represent each of the 15 voting members on the Federal Open Market Committee. Back in March of 2018, the Fed increased rates by 0.25%, and again last week in June by another 0.25% to a range today of 1.75 to 2%. Based on the median projections for 2018, would suggest 2 more rate hikes this year, followed by 3 more rate hikes in 2019 to the median of 3 to 3.25%. So essentially the Fed is indicating to us that interest rates should be around 3% over the next couple of years. So what is the Fed funds rate and why is this important? It's the rate at which banks lend reserve balances to each other on an overnight basis. And why does that matter? It can influence a majority of interest rates throughout the economy, including mortgage rates. So just quickly, why has the Fed been raising interest rates lately? Well, during the Great Recession in 2008, the Fed lowered the rate to effectively 0 in order to help stimulate growth and risk asset purchases in the U.S. economy. Amongst other policy tools used, rates were kept near 0 until the end of 2015, but now have been increased by 0.25 point 7 times, with again a likely 2 more coming for the rest of 2018. Now the Fed has a dual mandate to support employment and control inflation. And by facilitating what I'll call an easy money environment back a decade ago, the cost of debt became significantly cheaper and strengthened the incentive to purchase risk assets such as stocks and real estate. In other words, the 0.01% interest on your savings account paled in comparison over the last several years to the return potential from stocks and homes. As asset prices continue to rise over the last several years and unemployment continues to shrink, the risk of rising inflation emerges. At this stage in the cycle, stable to rising inflation appear likely, and the Fed has pursued its interest hiking policy in an attempt to prevent the economy from overheating. We've seen continued tightening in labor markets and more recently signs that wage increases are starting to pick up. Combined with the manufacturing recovery, appreciation in asset prices, and steady, albeit modest, economic growth, signs are pointing to higher inflation and thus higher interest rates. Now on page 4, one more consideration regarding the Fed is the size of the Federal Reserve's balance sheet. Part of the reason interest rates have remained so low is the Fed has been a large buyer of assets like U.S. Treasuries and mortgage-backed securities. which has helped keep a lid on rates and keep those easy money policies intact. Just briefly for our listeners, bond prices and interest rates have an inverse relationship. So as bond prices rise, rates will fall. Said differently, the Fed acted as a big part of the demand for bonds in the U.S. to prevent rates from rising. You'll notice the dramatic increase in the size of the Fed's balance sheet, really beginning during the Great Recession. That's that gray bar on the left side of the chart from 2008 to 2009 to where we are today. Towards the end of last year, we slowly have now started to see the chart turn lower, indicating the Fed is decreasing the size of its own balance sheet, or in other words, one of the largest buyers of these bonds is no longer in the market, creating that easy money scenario. On page 5, it's important to keep all of this within context. So we've talked about a couple of reasons why interest rates may be likely to move higher, at least from the standpoint of those short-term rates the Fed controls. But to keep things in context, what you're looking at on page 5 is the Fed funds rate dating back to the mid-1950s. You'll see we're clearly still near historic lows, but the trend is obviously moving higher recently. That said, over the long term, these rates are still reasonably attractive. Many of our listeners might recall the rate on their home mortgage in the 1970s or 1980s, and we're nowhere near those levels today. So financing for housing is still very affordable on a historic basis, but mortgage rates, as a function of those things I just discussed, have moved up in the first half of 2018. Jeff, this is your area of expertise, your bread and butter, and something that you and I have been talking about a lot over the last several months. We've shared some client situations during that time. You've been a huge help to us and to some of our clients. What are you seeing out there right now, and what kind of messages are you delivering to your clients and customers?
Well, thanks, Andy. I appreciate the introduction and the opportunity to be here. What I'm talking about with my clients, and as far as interest rates goes, is when they allow me to chart nerd out, I will share this chart that we're looking at on page 6, which is the mortgage-backed securities market, which is the marketplace that controls the interest rates for our industry for the most part. And what we're finding is if we always try to look for trends over a period of time. And this time last year, well, let's take a look at what's going on now. You'll notice the green lines at the top and the bottom are kind of acting like train tracks. And so that's a trend. And those train tracks are headed downward now. So we're definitely in a downward trend on the bond market, which means that we're in an upward trend on interest rates. And as Andy, you pointed out, one of the biggest buyers of mortgage-backed securities has left the marketplace. So I'm speaking to my clients about that, giving a little bit of the why behind what we're seeing in the interest rate market to give some explanation as to this chart. So right now, since what this is saying is we've had lower highs and lower lows in the trading bandwidth on this particular chart. So that means that rates are headed up. We don't really see a big change in that given the environment of what the Fed's doing and how their purchasing behaviors are panning out. And so we expect this to continue. And so do some other experts in the marketplace as well. So to decipher this, let's go to the next slide. Yeah. So since the beginning of the year, this is according to Freddie Mac. So what they do is they chart the delivery rates that they see on their books and then publish these, in the rearview mirror. So we're looking from, January to April currently, and it looks like we've lost, right around 0.5% to 0.75% in interest rate on Freddie Mac 30-year fixed rate loans. So that makes it a little bit more challenging to do what I call economic refinances, or refinances that are solely for economic purposes. And it makes it a little bit more budget conscious for those who are trying to purchase real estate. And so what we're seeing is a continued trend of this, given the fact that, the trends in the bond market and where we're headed. So in projecting outwards to the end of 2018, we expect it to be closer to, 5%. For some loans, I'm actually locking them at or above 5% right now for strategic purposes and or situational purposes, because there's about 40 different things that go into an interest rate quote that, and there's also some other factors like the price of the loan that we bake into the delivery rate. So we're there now for the most part, somewhere between 4.6 and 4.9. So when we're projecting that outward, we want to, and maybe move to the next slide there. We want to figure out what the cost of waiting is if we're trying to advise our people on purchasing. Now, this is a combination of what the experts think about what the prices of housing will do over the next 12 months. So we're using a national predictor from CoreLogic at 4.8% appreciation. And then Freddie Mac is predicting a 0.5% increase-ish by this time next year. So if we combine those two forces and project out, if we buy a mortgage today for $800,000 at 4.5%, and we project out to these factors next year, we're going to have to absorb $500 or $515 in our budget for those who are trying to purchase next year. So if there's a way that you can secure your purchase this year, that's ideal. Now that's harder to do than it sounds, given what we've got in the marketplace. Now, currently, it's hard for buyers to get into contract. When I speak to the marketplace, and when I say that, it's people on the ground selling real estate with people, so mortgage, or not mortgage, but real estate professionals. They're seeing a pivot in the marketplace. They're not seeing as many multiple offers happening. And so what that will spur is some media. And the media tends to spin things so that they get your eyeballs and get your attention. So when that starts to happen and you start to hear things about bubbles and crashes and things that can create some fear in the marketplace, this tool can help with the actual facts and numbers. So when we look at in any real estate marketplace, a neutral marketplace will be 6 to 7 months of inventory. So what that means is it takes between 6 and 7 months for the current inventory to be absorbed and moved from a seller to a buyer. Currently in the Seattle marketplace, we've got less than 1 month of inventory, which would then put us into the less than 6 months category, or a seller's marketplace. And until we start moving into 2, 3, maybe even 4 months of inventory, it still is going to be a little bit difficult on the buyers. If you happen to own real estate now, it's a great time because your home is going to appreciate. And the fewer months on the marketplace, the more it will tend to appreciate. So if you're looking for maybe a snapshot of what's happening in our local marketplace, on a monthly basis, we create a short video. I post it on my Facebook page so that people can check in and see how many months of inventory are in the Seattle marketplace. And it's, again, it's a rear view mirror type situation. You won't necessarily get the current exact current snapshot. You'd want to check with your real estate professional on that, but it gives you a flavor of what's been happening. So along with the rapid acceleration that we've experienced in home pricing and what the media likes to do, which is to grab your attention, I like to bring this chart to the table to talk about, you know, this boom, crash, and what we would think would normally happen without having experienced the boom and the crash of 2006 to the Great Recession in 2009, and the buildup of where we're at in 2017 and 2018. So what you're looking at is the actual prices of homes across the nation, according to the National Association of Realtors, from 2000 to 2017. Now, on the next slide, when we overlay what we would expect normal appreciation, and I recognize that normal is a setting on a washing machine, but typically what we would see is a more gentle increase in values that would keep up with inflation at a bare minimum. And, you know, typically the coasts perform a little bit better than inflation. So when you look at this chart, you can see exactly where our boom was and our bust was, and where we should be on a normal historic appreciation level, and we're just about there. And I would imagine if we look at, you know, year-to-date 2018, we would probably experience a leveling off of those two bars with actual and normal historic appreciation. So just to give you some perspective on some of the things that you may hear about in the news to arm yourselves with, you know, actual facts.
Jeff, thank you. That's really good color on what's going on, not only here in Seattle, but nationally. And you said about arming people with facts. If people have questions sort of today about where they're at in their real estate, maybe they're looking to buy, maybe they already own, maybe they're thinking about their mortgage, what should they do? What are their first steps in terms of, you know, evaluating this and making sure they're making informed decisions?
Sure. So as for our relationship building, we'll do an analysis of your current mortgage if you have one, and compare that to the marketplace. And more often than not, what we're finding is that an economic refinance is, you know, the window's fairly well shut. But we're always happy to measure things out, and then we do a rate watch report every month. So if there's any opportunities that pop up, then we let people know. That being said, what's happening now are more situational refinances where people are wanting to pull cash out for a purpose, a greater why than maybe the economics of their interest rate. So maybe they're looking to fund an education. Maybe they're looking to improve upon their home so it's a little bit more comfortable for their length of stay. Sadly, some people are getting a divorce. So there's some nuances of that situation that we can be helpful with in planning. For those who are looking to purchase, having the plan in place, making sure they bring, you know, a gun to a knife fight in the purchasing market, meaning that they're pre-underwritten, not only pre-approved, and they have a game plan A, they have a game plan B, maybe they don't want to move twice or be homeless. All those things we can help strategize with the person that's, you know, curious about that. So we want to make sure to help those who are planning their purchases and help them plan carefully, because they're going to be asked to do a lot of things that they normally would not need to if it were more of a neutral marketplace. So hopefully that helps.
Jeff, this is why I really enjoy working with you and sharing these client situations and these types of scenarios. So for our listeners out there, please feel free to reach out to either of us at any time. You know, at Cutler, our approach is to take that a quarterback and help our clients and work with good service providers like Jeff. So if you have questions about your housing or mortgage situations, please do not hesitate to give us a call. I'd like to thank everyone for their time and for dialing in today.
Andy Frey, Jeff McGinnis, thank you so much for your presentation today. We appreciate it. To those of you on the webinar, we look forward to having you join us in July for our second quarter market review and third quarter outlook, and that date will be sent out shortly. Thank you very much for your time. Jeff and Andy, again, great presentation. We appreciate the effort.